My next guest says Apple is a shrinking company and is overvalued at 30 times earnings. Joining me now is Bill Miller IV, Chairman and Chief Investment Officer of Miller Value Partners. It's great to see you, Bill. Welcome.
Thanks for having me, Kelly. Excited to be here.
I've been thinking about you the last few months as Apple's share price has not performed so well, and you might say there's more to it than just a pullback.
That's right. Well, I think somebody needs to tell the market that Apple is a shrinking company trading at a growth company multiple. If you think about the scale of Apple, as large as it is, in fact, if you think about the market as a whole and its constituencies, we're at a really interesting point in that 2% of the names in the market collectively comprise 33% of the market cap.
Wow.
That's because these mega cap companies are trading at very, very high multiples. That, by the way, 33% of the market for the top 2% of names, that's an all-time high, going back to the 70s. It's roughly on par with those levels. But if you just think about what it takes for Apple to grow from a $395 billion revenue base, you think about, okay, the economy grew at 6% in Q2, nominal. Let's take 6% of $395 billion. That's $24 billion in revenues. That's McDonald's revenues. That's Charles Schwab revenues. It took decades to create these companies. So to actually grow from this base is a very hard thing to do, yet it trades at 30 times earnings, which implies a high expectation for continued growth. Where
do you think fair value is? So the stock's around 175. It doesn't sound like you've been shorting it per se, because this would be a tough thing to do to do an almost $3 trillion company. But they are doing a lot of things. Listen, on the financial engineering front, you know, the share count's fallen by like 30% or more over the past decade. They've done a ton of share buybacks. I mean, they seem to be very eyes wide open to the realities that you're describing.
That's fair. There's obviously optionality. I mean, they could fire people, they could cut expenses, but most companies don't cut their way to greatness either. So there is optionality there. It obviously generates a ton of cash flow. It's in every single, a ton of people's hands around the world all the time. But again, that scale is a very hard thing to overcome.
We spoke with Paul Meeks yesterday, who was also quite bearish about the company. And by the way, there's Mark Zuckerberg exiting the meeting of AI leaders on Capitol Hill today. We're out there waiting to see if anyone wants to make additional comments to the press, which so far he and Bill Gates have declined to do. But Bill, as we talk about Apple, our guest yesterday said they missed their opportunity to buy a Tesla or to buy a, I think he might have used the Disney example. Maybe they still have that chance now. Should they do something transformative that would make you more bullish?
Well, I think the track record of companies doing massive M&A deals is generally not great. So that's probably not something I'd be looking to do if I ran the company. But, you know, I'm not sure exactly how they create value from here. But as an investor, what I think about is, what do I want to be buying? I want to be buying smaller to mid-cap companies whose valuations are nowhere near what these massive companies are. There's actually a real limit to what these companies can do. So if you think about Apple growing, such a massively scalable, or it has been so scalable in the past, if you think about what it would require for them to grow, it's very, very challenging. And I guess, again, you can cut stuff out, but they're stuck here. So from an investor's perspective, we want to be buying things with big free cash flow yields, good management teams. They're allocating money in intelligent ways, buying back their shares, and are certainly in tune with the situation.